Hello, everyone. A good physician friend of mine sent me this article asking for my thoughts. And after reading it, this one was worth making a quick video on, since articles like this tend to do physicians more harm than good in our experience. So the article comes to us from the Wall Street Journal. And the basic claim being made is that certain financial decisions can conflict with how an advisor is paid. Right? AKA the advisor's fee structure incentivizes them to make recommendations that aren't in the client's best interest. Okay, so this is a simple enough premise, and as an advisor, I was intrigued myself since my firm uses a very low percentage of assets pricing model. Right? The way we do it is quite different than the industry's straight 1% to 2% approach. So anytime that I get a chance to preach against the industry in this respect, I will generally take advantage of the opportunity. Okay, so that said, though I agree with the article in spirit that the pure 1% of asset pricing model does have flaws, attempting to tie financial planning decisions, like at what age to start Social Security or paying off a mortgage faster or slower, to an advisor's fee incentives, felt more like kind of an arbitrary sucker punch against advisors, more than it was correlated to anything in actual reality. Okay, so I find myself in this awkward spot of defending advisors who might otherwise kind of disagree with on how they charge their fees. But as it relates to this article, the claims being made are fairly poorly substantiated. So I'm erring on the side of something I would kind of generally be against. So let's take a quick look at this. Okay, so here's the article. Your financial advisor doesn't want you to know about these conflicts. Fee-based advisors sometimes recommend drawing Social Security early and holding on to mortgages. Okay, so I just had to write all this out myself, so my thoughts are in red. I'm just going to kind of read through this line by line through the article and kind of my response. All right, so the implied claim with the teaser line here is that being a fee-based advisor is in some way correlated to when clients start taking Social Security or when they pay a mortgage off. And the question I'm kind of stuck with here at the beginning is, are we dealing with a solution that's looking for a problem? So let's keep going. There's been a seismic shift in the way Americans pay their financial advisor, right? And it hasn't erased these conflicts of interest. In the past decade, people have moved trillions of dollars to advisors who charge fees rather than commissions. These advisors typically charge clients annual fees, often between 0.75 and 1.25%. I would agree with this. This is kind of the general industry average. We say 1% to 2%. The fee-based financial planners are a hit with regulators and consumer advocates, in part because they often don't earn commissions, a practice that was encouraged by some brokers to push expensive financial products. This is back in the day. We're going to come back to this don't earn commissions piece in a second. So the bottom line is this article, kind of the title infers one thing and the first two paragraphs are another, right? It starts by lauding the fee-based approach and its virtues relative to the older commission-based, more transactional way of business, which I do disagree with. That's an old way of doing business, and the fee-based model is better, right? So I agree with this broadly. The fee-based approach better aligns incentives of the client with the advisor relative to a commission-based structure. Still, the fee-based structure can tempt advisors to make recommendations that maximize a portfolio balance. We're going to come back to that piece too. Maximizing a portfolio balance, generally something people like, even when doing so isn't in a client's best interest. I disagree with this, according to academics and researchers. In one example, people who pay advisors portfolio-based fees claim Social Security earlier than what is often considered ideal and at the same age as those who aren't getting any advice at all. Okay, this is where things start to break down, but we're going to continue. Fee-based compensation is generally considered less prone to abuse than commissions, but we're seeing some behaviors among fee-only advisors that also represent clear conflicts of interest, says Michael Finke, professor at American College. Okay, so They're going to dive into this. And their claim is that the timing of Social Security and when someone pays off a mortgage, the implication is it's somehow correlated to fees being charged. David Blanchett, head of retirement research at PGIM DC Solutions, an affiliate of Prudential Financial, co-wrote a study that found that people who used fee-based advisors took their Social Security benefits at age 65 on average. Though people can claim Social Security as early as 62, holding off until later guarantees they may hire a monthly check. It is often optimal, strong language, for the spouse with higher earnings to delay claiming until age 70. All right, so my initial feedback here, this is true. Waiting longer to start taking Social Security does guarantee a higher monthly paycheck. But waiting longer also guarantees one will receive fewer Social Security checks. Simple math right here. If someone lives to 85 and starts taking Social Security at 62, they're going to collect 23 years of Social Security. If that person starts later at age 70, as the article implies, waiting is better, they're going to collect 15 years of Social Security. So we're left with the question here. Is it better to start Social Security earlier and presumably collect a smaller amount, but over a longer time frame? Or is it better to wait until you're older, collect a larger amount each check, but over a shorter time frame? Right? In my submission here to the critical reader is the notion of what's better between these two Social Security alternatives is exactly the question an advisor helps a client answer. Right? And the answer to this question for anyone requires a lot more financial information than what's being given here in this article. But we're going to hit on that piece later. All right. But advisors tend to earn more fees when their clients claim Social Security soon after retiring because clients don't take as much from their portfolios. I understand the argument the sentence is attempting to make, but it is such an academic oversimplification that it is almost impossible to address meaningfully in a terse way to respond to this. So I'm actually not even going to try. We're going to just move on here. I would have thought that people with an advisor would claim later, since advisors should be aware of the benefits. Blanchett concluded. He concluded that the way advisors are paid is likely influencing their recommendations. Again, I hate to be discharitable here, but most would have thought anyone possessing a PhD, CFA, and CFP credentials would be vastly more academically capable of discerning correlated cause and effect of the dynamic nature of any financial planning decision, such as when to take Social Security, beyond what feels like a simple pot shot of fees are influencing recommendations. My heart hurt reading this. Reducing the decision of when someone takes Social Security down to incentive misalignment seems to speak more to someone's lack of understanding of what real advisors help real clients with. A lot of information goes into helping a client make this kind of call. Are they still working? When do they plan to stop working? The makeup of someone's assets, the tax treatment of those assets, current and expected income tax rates, what state someone lives in. Are they simply trying to make it through their old age without running out of money? Or are they trying to maximize a larger estate? Yes, their age and personal feelings on life expectancy also matter. The reality of Social Security's structural issues play a huge part in this for most people. If I speak for myself here, how revenue is impacted when a client takes Social Security hadn't even crossed my conscious awareness prior to reading this article. There are bad apples out there in the industry, as any industry, but any fiduciary advisor who is worth their salt, the notion of their impact on fees on when a client takes Social Security is so far out of the realm of just normal operating. It's like, again, I'm embarrassed to have to even address it in some degree. I would submit this far less of a point for most fee-based advisors as this article is suggesting. Okay, so let's move forward here. So it goes on to quote this fact here. There's a study done on 260 households with 500,000 more in assets. Man, again, very, very, very vague. I mean, 500,000 more in assets. That could mean someone has a $500,000 house and no debt and no other investments. I mean, that's a lot of issues for most people. It could be all investable assets. I mean, it's just it's so vague and so it's vague to the point of being unhelpful, right? It then uses here a case study, right? Consider a man who retires at 65 with $2 million and spends $7,500 a month. If he has a choice between taking $3,400 a month in Social Security at 65 or $5,000 a month starting at 70, he will maximize his lifetime benefit by waiting until 70, provided that he or his spouse lives to age 83. Again, if you look at Social Security in a silo, as this case study is doing, the math is probably right. The bottom line, though, is there's so much more that goes into this than a siloed view of what's being shown here, right? If you can, consider a perfectly crafted scenario that fits exactly into the narrow argument being made. That's what this is. It's frustratingly oversimplified. What's the makeup of the $2 million? Is the $1 million investments? Is it a home? Is it all investable? If so, is it tax deferred, Roth money, non-qualified? Some combination of the three most likely. Does this man think he'll live past the Social Security life expectancy age? If so, how much more? Or if not, how much less? Can someone please direct me to the people out there who would accept their advisor coming to them with such basic reasoning around their Social Security recommendations? I cannot imagine how clients would react if we justified our Social Security start age with such a simplistic, siloed approach as what's being shown here. Most clients working with an advisor are looking for well thought out and dynamic reasoning using their unique financial facts to make these decisions. It is very hard to make a catch-all recommendation as this is attempting to do, right? And it's like I said, it's so vague. It's to the point of being unhelpful to most people. All right, so it continues. If he waits until age 70, he would need to withdraw $450,000 from his investment accounts to support himself from 65 to 70. If he instead claims at 65 earlier, he would only need to withdraw $246,000 since his $3,400 Social Security check would cover some of his living expenses. This may be 100% true, right? But it's attempting to associate fees as the primary driver behind the decision making here, right? Most clients want higher account balances, as this example is suggesting, not lower. Maybe the client wants or should maintain a more liquid financial stance, and taking Social Security aids them in that if they take it earlier. These are all very reasonable planning objectives, and all may yield higher account balances too. So in raw exasperation, if an advisor is in fact earning more revenue on higher account balances, could that not be anything more than an incidental result to an otherwise win-win solution for the client and the advisor? Many people simply don't want to spend down their assets earlier in their life, earlier in their retirement, if it's going to make them more reliant on Social Security as they age. We're on to paying off mortgages now, right? The idea here is paying off a mortgage sooner is better, and that an advisor is not incentivized to have someone pay off their mortgage sooner because it takes away from their investable assets. So eliminating debt was once considered a key part of preparing for retirement. As interest rates fell over the past decade, holding onto a mortgage later in life became more common. Advisors have a financial motive to agree with this strategy. It's not the advisor's fault that interest rates come down, and it's therefore better or maybe better for someone to not pay down debt, and the advisor therefore makes more money because they're not taking money out of a client's not taking money out of their account balances, right? This feels like a solution looking for a problem. Can two things be true at once? Can interest rates falling over time sway the math in favor of not paying a mortgage off faster, which in turn means a client has more investable assets, which in turn means an advisor is managing more money for a client and therefore earning more revenue? Yes, yes, yes. But this is a cart leading the horse kind of argument. It's not the fact that there's a fee incentive here that's driving this. It's in this case, it's the fact that interest rates came down over the last decade. All right, so it goes on to give this case study of someone with $1 million. I honestly, it's hard to even respond, right? Consider someone with a $500,000 mortgage and $1 million portfolio, and is paying their advisor a 1% annual fee. Again, I disagree with the flat 1% to 2% model. That's my caveat to all this, but in this case, I would still say it's probably worth this person paying a 1% fee to avoid what could be a catastrophic mistake here. If the client withdraws $500,000 from the portfolio to eliminate the mortgage, the account balance and the account balance and advisor's pay is halved. That is a statement of fact. But I pray that anyone reading this article talks to an advisor before taking 50% of their investable assets to go pay off a mortgage. Planting ideas like this is exactly why the advisor profession exists. Again, it is beyond the scope of this response to get into the full why or why not here. But if you polled 1,000 advisors and gave whatever the scenario was and whatever the more background of this client, most advisors are likely going to say it is not in the client's best interest to pay off this mortgage, regardless of the fees, right? Most clients are going to look at the actual math associated with this, and they are going to arrive at the same conclusion. The fee is worth them making this mistake. Okay. All right, so he goes on here, right? In recent years, the percentage of households age 65 or older with mortgages has risen from 15% in 1989 to 29% in 2019, according to Boston College Center of Retirement Research. Okay, mortgage rates were over 10% in 1989 for most of the year. In 2019, mortgage rates were sub 4% for most that year. Again, charitably, perhaps advisor fees did have something to do with this jump from 15 to 29% from in 1989 to 2019. But I would venture to say that anything that advisor fees had to do with that absolutely pales in comparison to the macroeconomic environment that clients and advisors are operating in and that are trying to maximize for their benefit, right? It is vastly more explanatory than the advisor fee for why people hold higher mortgage balances over these two time periods. Let's see here. Keeps going here. So advisors argue that their clients have a better chance of earning higher returns by leaving their money in the stock market than they would get by selling their investments to eliminate mortgages. Yes, advisors do generally say this. I would say it as a general statement. But it's not. Again, that's not an opinion that advisors have. It's a statement of fact, right? If you look at historical returns and if you believe that those will carry forward relative to your interest rate on your mortgage, there's a very viable reason for that recommendation, right? Recent history has proved them right. Over the past 5 years, the S&P 500 has gained an annualized 14.7% per FactSet, blah, 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 far exceeding the mortgage cost of 30-year of 3%. Okay, they're making the case here that most reasonable people would make, most advisors and clients. Some people might also get a tax deduction. Finally, yes, we're dipping our toe into the real life complexities that go into these decisions. Thank you, article, for at least giving an homage that this is way beyond just a simplistic BS up to this point. But not everyone is comfortable using debt to bet on the stock market, said Alan Moore, Chief Executive Officer. Okay, I know XY Planning Network well. Again, I agree with them in spirit. And I would just say to Alan or anybody else, if someone is not comfortable betting on the stock market, then they shouldn't, right? A good advisor isn't going to take a value stance on this. A good advisor is going to calculate the costs and the trade-offs of such a decision and then allow the client to make the value judgment as to whether paying off their mortgage sooner is worth it, quote unquote. This is the job of the advisor, right? It is to provide objective, emotionless-based analysis that is understandable for the client to then go make a decision. It's to not make an assertion here that it is somehow better or not better to pay off debt. But most people, when they look at the markets, when they look at the tax implications of taking $500,000 out of their portfolio, and when they look at the long-term impact that all has on their net worth, and that's hundreds of thousands or millions of dollars in many cases, they're going to look at you and be like, gosh, that is a very expensive trade-off. I don't know that I want to go do this. And that's fine. Someone who's very, very risk-averse might say, it is worth it to me. The advisor doesn't make that call. They do the math. They let the client make that call. All right. Buying an annuity is the third and final thing here. All right. Some fee-based advisors shy away from annuities, including a type that some economists recommend. The writing here is so high level and so vague. It's just a challenge. Any advisor claiming to be fee-based has to shy away from annuities because almost all annuities charge a commission. Fee-based advisors, if they're at least claiming that, are not allowed to earn a commission on investment products, right? So exactly what we said was a bad thing at the start of the article is now being like flip-flopped in reverse. Like you just can't have it both ways. Gosh, I don't even know if I can go further. So annuities have critics, partly because many varieties have high fees. Duh, right? But some economists like immediate annuities. Great. Economists aren't advisors, right? In part because they remove the possibility of going broke in old age. I love annuities too. It's a trade-off thing again, right? If the trade-off is worth the cost, the client will do it. No advisor who is fee-based is doing commission-based annuities, right? So the article is hopping all over the place here. Commissions are okay. Now they're not okay. Now they are okay. Now economists are saying this about annuities. Annuities are bad. It's like, whoa, everyone pump the brakes. Like all there is fact and truth. What's the situation? What's the tools that we can apply to maximize it? The client makes a value-based decision. I hope I wrote down that I hope the reader can see the contradiction and irony within the article at this point. Okay, yes, I was being a little tongue in cheek here. You know, advisors don't generally share an economist's enthusiasm. Yes, because most fee-based advisors disagree with the incentive structure of commission-based annuities. That's why they don't do them. No, it's not because it's moving out of money in an investment account. If I have the option between charging a fee or most advisors have the option of charging a fee on an investment account over the long term, this 0.75 to 1.25, or earning a 3 to 7% commission, they're going to go to the commission route, right? Think about this: $1 million annuity. If you pull $1 million out of an investment account and you drop it in an annuity that pays a 3 to 7% commission, at the high end, that advisor, who I wouldn't even call an advisor at that point because they're working for a broker dealer, it's not advisory when you're earning commissions in this way. But that advisor is earning $70,000 commission on that $1 million annuity sale, right? The sales-based world is great for money because you drop someone into these things and you walk away, right? Fee-based advisors don't believe in that, right? Even though they could go make more money by dropping people into these commission-based products, they generally don't agree because they know that it's a misaligned incentive structure. They have the much lower annual fee. They accept that, and they have to earn it over a much longer time frame because it's better for the client. They are so seldom used by advisors that one has to ask the question of whether conflicts of interest preventing the advisor from presenting. Here's what I would say. There are lots of annuities out there that are designed with a fee-based structure, right? And that way you get out of this commission world. It fits into this fee-based notion that the article claims in the beginning is better than commission. And it solves a lot of problems. But I'm just going to finish with 3 final thoughts. Yes, I agree that the pure 1 to 2% asset-based fee model can and should be improved upon. It's a vast improvement compared to the commission model, but it can cause negative incentive alignment issues. Our firm advocates for this with our own fee schedule, right? We have a very different fee schedule to the industry, with a much higher focus on fixed and a very low variable cost. So I do agree with that. I am in full-throated disagreement in how this article attempts to approach questions of Social Security or mortgage payoff, and that's somehow being tied to fee alignment incentives. The way the article puts it, at least, is it's a very shaky argument. And I would argue it does more harm than good to the consumer. The reality on the ground is for any well-credentialed, legitimate financial advisor, the impact to fees does not cross their mind when helping a client make a call on questions like this. Sometimes the answers to these questions result in more assets being managed, and other times it results in less assets being managed. And that leads to my last point, the plan. The financial plan is and always should be the driver behind any financial decision. A financial plan is nothing more than all of one's detailed, comprehensive financial information organized in a single spot. That way, the cause and effect of any financial decision, whether it's when to take Social Security, whether to pay off a mortgage faster or slower, or whether to buy an annuity, can be modeled for the client so the cost benefit is clearly discernible. The client can then make the value judgment on what makes sense for them. Any fee impact that this process has is simply incidental to being a fiduciary advisor. And that is all I have. Thank you.